for joining us during this weekly hybrid MLS breakfast meeting. My name is Wai-Ming Lee, and I'm your October program chair. Okay, now today we're going to have our main feature now. Before I start, I'm going to give you a little bio about our speaker, Bella Khoo. Okay. Bella has been working in the mortgage industry for 7 years. Her role is to monitor the mortgage market on a weekly basis to make sure the bank's interest rate is the best position in the market. And you know the interest rate has gone up quite a bit since last year. So we have a lot of information to learn. She leads the mortgage loan sales team and partners with industry leading builders on California newly built properties. Also, she's in charge of mortgage loan officer training and local branch support. So without further ado, let's welcome our speaker, Bella Khoo.
Good morning, everyone. My name is Bella from East West Bank. Thank you for inviting me. And I see our coworker, Phoebe there. Yeah, we often call together, so thank you. So today I'm here to answer some of your questions and address some of your concerns regarding to interest rate, and hope my presentation today will help you a little bit when you talk to your buyers regarding to the mortgage industry and also the whole interest rate environment. So today I have about 6 topics to discuss. So first of all, I want to start with a 2024 year-to-date interest rate environment recap to kick off our presentation. So this graph shows a 2024 year-to-date mortgage interest rate. The blue line is the 30-year fixed mortgage, and the green line is the 15-year fixed mortgage interest rate. Okay. So I want to separate the fixed rate versus the ARMs rate because these two products are a little bit different, and I will explain why. Okay. And the horizontal axis represents the month of the year, which the vertical axis represents the interest rate. Okay. So as you can tell in the middle, that's the mortgage interest rate has been stably high in the first 2 quarters of 2024, which we all know and have seen the change. And as of mid-August, the average mortgage rate on 30-year fixed dropped from its peak around 7% to 6%, right? And 30-year mortgage rate have been more or less stably falling for weeks in anticipation of the Federal Open Market Committee meeting, which was held on September the 18th. Till the day earlier, it reached out to 5.89%, which is the lowest average in just over 2 years. Okay, so over 2 years, Fed the mortgage interest rate has not been dropped for any bit. We keep at around mid-7 to a mid-6 range. Okay. However, on September the 18th, after Fed holds its meeting, and they decide to lower the target range for the federal funds rate by 50. Oh, it's still the last slide, please. Yeah, by 50 base point. And the very next date, the mortgage rate actually went up. Okay, so we all wonder why is that happening. So first of all, we receive like so many calls, and almost everybody is asking me, oh, why Fed drops the rate, but the mortgage industry actually went up, or why it's still so high, so our buyers are not buying. Okay, so first of all, I think we gotta clarify what Fed is dropping. So what the Fed Open Market Committee is actually dropping is the Federal Reserve rate. So that is different from the mortgage interest rate. Okay. So this rate dictates how much banks pay each other in interest to borrow funds from their reserves. And is impacted by so many factors. So for example, stock market, inflation, unemployment rate, and most importantly this year is affecting by the president election. Okay, so I know at the beginning of this year, there are so many news regarding to Fed was going to drop 6 times this year, but see what's happening. They only dropped once in September so far. So there might be another rate drop in December, but we'll see what's going on after the election. So the Fed reserve rate has more direct impact on the short-term debt product. For example, credit cards, short-term personal loans, and also our HELOCs. Okay. So also the mortgage interest rate did not drop after Fed cuts the rate, but HELOCs rate drops on the second day on September the 19th. Okay, because HELOC rate has direct more impact by the Federal Reserve rate, but mortgage rate is not. Okay. The Federal Reserve rate does not have a direct impact on the mortgage rate, but it does have a direct impact on the HELOCs rate. Okay. So right now is actually a great opportunity for our buyers to get a HELOC before they buy a property, because the HELOC rate is actually dropping, has the trending to drop compared to the mortgage interest rate, which is remain as high as current. You might ask, so what is actually deciding the mortgage interest rate? First of all, I want to start to explain the formula which we calculate the mortgage interest rate. It's simply as index plus margin. So what is index? Is a reference rate that we use as our base rate. So for example, for fixed rate mortgage is tied to the 10-year treasury. Okay. And this 10-year treasury is more stable compared to the Federal Reserve rate or any other short-term debt product rate. Okay. And the margin is each lender's profitability. So this interest rate is simply calculated as index plus margin. The index might change, but the margin, most likely they will remain the same as yours. Okay, unless this lender changes strategy. So why I want to separate the fixed rate mortgage versus the adjustable rate mortgage is because fixed rate mortgage is usually fixed at a 15-year fix or a 30-year fix. So the interest rate is stable, it won't change. But the ARM loan, we will tie to a secure overnight financing rate, or at East West, we use the T-bill rate, okay, which will change a little bit more often, maybe every week, maybe a couple weeks, maybe every month. So by saying this, the ARM loan has an indirect impact by the Federal Reserve rate. But as you can see, after Fed drops the rate on September the 18th, actually the mainstream banks like Chase, Bank of America, Wells Fargo, US Bank, their ARMs rate has been adjusted a little bit, but not the fixed mortgage rate. So what is affecting the home market? Okay. First of all, is affecting by the inflation, demand and supply, and also the mortgage interest rate, because buyers' behavior might be affected by the interest rate. If the interest is too high, especially for the first-time home buyer, they might hesitating to look for houses, right? Also, we see a trending that we know there is a new rule that implemented by the National Association of Realtors, which basically the buyer's agents commission is come out from buyer's pocket starting on August the 17th this year. So in the short term, we actually see a impact on the buyer's behavior. Okay. So as you all know, although the interest rate remained very high in the second quarter of this year, but actually from East West perspective, our purchase file volume was really high and was increasing before August. Okay. Part of the reason it was because summer is always the house hunting season, right? That's the first reason. But the second reason was because that's what we have discussed, was because buyers were kind of concerning about the new rule in August. So they want to get the house bought before the new rule got kicked out. Okay. Why I said that is because right after August, our purchase file volume drops almost half. Okay. Nobody was buying, although the interest start to lower a little bit. So we were a little concerned about the purchase volume. So by addressing the concern, we actually drop our rate by 50 base points before September, hopefully to kind of trigger or encourage our buyers to, to apply an application with us. But guess what happened? We didn't see much. Okay. So this will come to another, my next bullet point, which is consumers' anticipation. Okay. So actually, our buyers' behavior are impacting by their anticipation. Okay. Why we dropped the rate by 50 base point in August, but there is not much files came in? Because all the borrower still expecting we will have another rate drop in September. So they want to hold and wait to see the market. Okay. Even our refinance or cash out borrowers, they were hesitating to lock the rate. Even we lowered the interest rate by 50 base point in August. Okay, because they know that the interest rate might go down in September again. But guess what happened? We didn't drop our rate after August. After the Fed meeting, our rate still remained the same. Okay, because the Federal Reserve rate doesn't have a direct impact on our mortgage interest rate. What is the most interesting is, even our interest rate remained the same as August, right after September the 18th, we got our purchase file volume doubled. Okay, our interest rate did not change, but our volume got doubled. So this has something to do with our consumers' anticipation. So by talking about this consumer anticipation, this is something that I always talk to our branch loan officers and my own team is it is very important to manage your borrower's expectation and anticipation. Because everyone sitting here, we are professionals, but our buyers, they are actually the outsiders. Okay, so it is very important for you to educate and to manage your borrower's expectation and anticipation. Okay, by telling them some market insights and also let them know, the Fed's interest rate, the Federal Reserve rate doesn't have a direct impact on the mortgage interest rate. And when the mortgage interest rate goes down, the housing price might go up. So I think it's our duties, is our responsibility to manage their expectation, to make sure they have their right, or to encourage their buying behavior. So I'm not an economist, so I rely on CoreLogic's data so much, which I will go to their annual meeting hosted in SoCal every year. So I want to give you some pricing insights by CoreLogic, which they are a big data engine in the whole United States, even in England and Australia. So according to CoreLogic's market analysis in September 2024, the home price nationwide, including distressed sales, increased year over year by 4.3% in July 2024 compared with last year, which is July 2023. Okay. On the right side of my PowerPoint, you can see the home price changes in 10 selected large US metro city from July 2023 to July 2024. You can tell in LA County, the sales price actually went up by 4%, as well as Las Vegas, Miami, and San Diego. It all went up by over 6%. CoreLogic home pricing insight forecast also indicates the home price will increase by 2.2% on a year-over-year basis from July 2024 to July 2025. Okay, this might due to inflation, might due to the mortgage interest rate might drop, so the home price might go up. Okay. Although the increase is minor, but the home price is still going to be increased a little bit. So this is also a time for you to remind your buyers and also manage their anticipation on the home price. Okay, don't wait. Okay, by now, although the interest rate might be a little higher than next year, but they get a chance to refi anytime, right? Because in California, there is statistics that showing our buyers or our homeowners refi their homes every 3 to 5 years. That is just a California data. Okay, so you may use these data or statistics to educate and to manage their expectation, which will encourage they buy without much concern on the interest rate or the home market. Okay, hopefully. All right, so much of this sluggishness may be attributed to the high mortgage interest rate that are continuing to challenge the housing market. So as buyers remain cautious, the sales remain slow. However, the highly anticipation rate cut from the Federal Reserve this fall may help improve their buying behaviors. So I know this has nothing to do, less things to do with you sitting as the realtors here, but you might be sitting here as one of the consumers as well, because I believe most of you here owns that property, at least one properties, right? So there are nearly $735 billion in loan with rates above 6.75% in the United States. And all these amount of loans will come to a chance to do a refi. at end of this year or next year. Okay. So as I mentioned earlier, California does have the statistics. All homeowners refi their homes every 3 to 5 years. So this might be an opportunity for them to do a refi. And I always talk to my customers is there will only make more sense if you refi, if the interest rate is at least 1% lower than your current mortgage interest rate. Otherwise, the cost might be a little more because there might be escrows and appraisal charges, right? So for when these loans are with the 6.75%, when the rate drops below 5.75%, all these homeowners will come to us, come to the lenders and do a refinance, most likely. All right. So this concludes my presentation. We are open up to the Q&A session. If you have any questions, please welcome to ask.
Hi, good morning. I wanted to know for the HELOC loan, because I saw some bank, they offer like 9 point something, some like offer like 7.99, 9.99. Is there any like regulation for the interest rate, like the maximum, the minimum, something like this for the HELOC loan? Because you said the HELOC loan is more impact by the Federal Reserve rate, right? Yeah.
So there is no regulation set a ceiling for the HELOC rate. However, HELOC rate also calculated as index plus margin. So what the HELOCs use the index usually, for example, East West, we use Wall Street Journal Prime. So it's very easy to calculate our interest. For example, you might use Wall Street Journal Prime plus or margin, which might be a 0.75% or it might be a 1.5%, depends on the property type. So same as other banks, they might have a margin plus the index, and the index is fixed. So there is no ceiling for the HELOC rate. Yeah, but I know some of the banks, they have an initial draw discount. Meaning like if they draw the HELOC out of the account right after the loan is funded, they might give a borrower a discount on that. Yeah.
So should we be excited for the coming year?
Oh yeah, I think so. I
You
think so. Yeah.
Okay. When should that excitement start? Like
Oh,
beginning or
We
I
are
don't
all
wanna jump the
expecting
gun.
maybe after the election. Let's see what's going on in December.
Okay.
Yeah.
Because I got excited and then now I'm depressed and it's a emotional roller coaster. Sure everybody knows they're talking about. Any more questions? That's it for Bella? Oh, okay.
Hey, Bella, got a question. For most of us who bought our house long time ago, interest rate was hovering between 3 to 5%, and now is at 6.25%. I think it's going to have a negative impact on people refinancing. And you're talking about refinancing, hoping it will drop. Why
So-
would I do it? Let's say if I have a house that I bought at 3 or 4%, why would I do refinance unless I'm forced or whatever reason to buy a new home?
Okay, so this has something to do with the product called cash out refinance.
Oh.
Maybe you have a plan to buy a investment property, right? To cash out some of the equity from the current house. Or if you don't want to touch the existing mortgage with the 3% interest rate, this is a chance for you to do a second lien HELOC to get the equity off the property and buy another investment property. We have a lot of borrowers who do that.
A good point.
Yeah.
A second question, last question. One of the presidential candidate, she suggests that we will give the first-time home buyer $25,000 as down payment. Would that just add to the seller's expectation that I'm going to raise my property by another 25,000? So it's just a zero-sum gain.
Oh.
What incentive does that have, for anybody?
Okay, this is a very good question. So, thank you for mentioning this. So actually, seller might hesitate. I have seen sellers, they might hesitate when they know the buyer is gonna have some assistance program from the government. So they might worry this will affect, or they might have a lower chance to get a loan approved from lenders. Okay, and also for buyers, make sure, for example, every bank has different underwriting policies. But for example, some of the lenders, if they know that this buyer is gonna get a loan, like a loan assistance or like a down payment assistance program from the government, this might affect their loan to value. Okay, because whatever the government will assist them is considered to be a loan, even though eventually after 10 to 15 years later, they don't have to pay government back. But this is still considered as a loan to a lender when they get this kind of assistance program from the government. Okay, so for example, if the buyer is buying a, for example, just $1 million property, but they might get a 200,000 assistance program from the government, right? This is actually affecting their loan to value. Okay, we will use these funds to minus whatever we could lend to the customer first. Okay, so thank you for bringing this up. Yeah, lenders has different calculations, but some of the lenders, they do include this kind of assistance program as part of a loan. Right. Right. And sellers might concern, oh, I see you got an assistance from the government. Is this going to affect your ability to afford the monthly payment? So they might have this concern, because I have seen some some sellers, they don't want to sell a property or getting a contract with the buyer who's gonna get a FHA loans. Okay, this might be kind of discrimination, but sellers might consider this, from this perspective, and nothing wrong with it.
Okay, thank you so much, Bella. That was excellent, very informative. And I'll turn it back to Mr. Lee. Thank you, Bella.
On behalf of the West and Gilbert Valley Realtors, I would like to thank Bella Cool, East West Bank, for a very informative session. I hope you guys have learned a lot, just as much as I did on some of these changes. It's good to watch your interest rate and talk to experts such as them. We have a lot of lender here. Ask them whatever question you have, because it might actually affect and impact negatively your buyer's ability to borrow money or find a new home. So just keep a tap on the market. Join us next week as we welcome our Felix panel. Their topic will be, this is a very important topic, and something true to my heart. Your network is your net worth. Thank you everyone for joining our meeting today. Have a wonderful day. The meeting is now adjourned. Thank you for coming. Bye-bye.